You're watching your restaurant fill up every single night. Lines out the door, customers raving about the food, new locations opening every quarter. Your entire retirement sits in a generic target date fund, managed by an analyst who's never eaten there. That disconnect between what you know about a thriving business and what you actually do with your money is exactly what Peter Lynch wrote about in Beating the Street. In part 1, we covered how Lynch built the foundation, his philosophy on invest in what you know, his approach to amateur advantages, and the basics of finding great companies. Now we're going deeper. This is part 2, the sector-by-sector playbook. Cyclicals, utilities, turnarounds, restaurants, and the 25 golden rules Lynch distilled from turning $18 million into $14 billion. By the end of this video, you'll have the complete picture. Every strategy, every framework, every rule. Let's get into it. Here's something most investors never consider. The best companies aren't always in the best industries. Lynch calls this blossoms in the desert. Imagine finding a rose growing in the middle of a parking lot. That rose didn't survive despite the concrete. It thrived because of it. No competition for sunlight. No other plant stealing nutrients. Just one stubborn flower doing incredibly well in a place nobody else wanted to be. That's Lynch's strategy for Chapter 11. He argues that boring, ugly, depressed industries drive away 3 things at once: competition, analyst coverage, and investor attention. And when all 3 disappear, mispricings last for years. He invested in waste management companies, funeral services, office supplies. These are businesses nobody brags about at dinner parties. Nobody posts about them on social media. Nobody writes breathless headlines about the future of garbage collection. And that's precisely why they produced consistent 20% plus annual returns. Because everyone was too embarrassed to look. That frustration of knowing something works because you've seen it with your own eyes, but watching your money sit somewhere lifeless? Sam carried that weight into every investing decision. A friend pitched him 2 investments on the same night. The first was a waste management company expanding into 3 new states. The second was a buzzy food tech startup with a slick app and a celebrity endorsement. Sam didn't even think about it. He put his money into the startup. It felt modern. It felt exciting. 3 years later, the waste management stock climbed 60%. The startup? It ceased operations 11 months in. Sam stared at his brokerage account for a long time that evening. He learned something that night that no app could teach him. Exciting investments and profitable investments are often complete opposites. A hailstorm hits a car dealership. Every single car on the lot gets marked down, but 3 of those cars were parked inside the garage. They're completely untouched, yet the dealership is selling them at hailstorm prices. That's what Lynch saw in the S&L market. Now, you might be thinking, that's nice for the 1990s, but does it still apply? Absolutely. Sam experienced something remarkably similar. A major data breach hit a competitor in his restaurant chains industry. Cybersecurity stocks across the entire food service sector dropped 15% in a week. Sam's company, which had invested heavily in data protection and had nothing to do with the breach, got dragged down with everyone else. But this time, Sam recognized the pattern. He'd read Lynch. He understood guilt by association panic. He bought more shares of his own company at the discounted price. 6 months later, the stock recovered completely, and then kept climbing. Now pay attention to this next part because it connects everything we've covered so far. Chapter 14 introduces something most retail investors have never heard of: Master Limited Partnerships, or MLPs. These are investment vehicles that combine the tax advantages of partnerships with the tradability of stocks. Lynch liked them specifically in industries with predictable, boring cash flows. Pipelines, energy distribution, the infrastructure that keeps the world running but never makes headlines. The appeal is straightforward. MLPs generate consistent income through distributions, often higher than dividend stocks. And they come with tax advantages that make the effective yield even sweeter. Lynch's warning: only invest in MLPs where the underlying business is so boring it puts you to sleep. If an MLP sounds exciting, something's probably wrong. Stay with me here because this next idea changes the game. Chapter 15 is where Lynch drops one of the most counterintuitive concepts in all of investing: and it has to do with how you read a price-to-earnings ratio. For growth stocks, a high PE means expensive. A low PE means cheap. Simple. Every investing course teaches this. Every financial website displays it as gospel. But for cyclical stocks, companies in steel, autos, airlines, chemicals, paper, the rules flip completely upside down. A high PE on a cyclical stock is actually a buy signal. A low PE is a sell signal. And if you don't understand why, you'll lose money doing exactly what seems logical. Here's the reasoning. Cyclical companies have earnings that swing wildly with the economy. When the industry is at the bottom, cars aren't selling, steel orders are drying up, earnings drop to almost nothing. When you divide the stock price by those tiny earnings, you get a massive PE ratio, 40, 50, sometimes higher. Every traditional investor looks at that number and says, too expensive, stay away. But Lynch says, buy, because those rock-bottom earnings are about to recover. People can postpone buying a new car for 2 years, maybe 3. But eventually, every car on the road needs replacing. That deferred demand creates an explosion in cyclical earnings when the cycle turns. And when earnings surge, the PE drops to 8, maybe 10. Now, every traditional investor says, what a bargain. Low PE, time to buy, Lynch says sell. Because those peak earnings have nowhere to go but down. It's like shopping for winter coats. You don't buy a coat in January when everyone else wants one, and the prices are at peak. You buy it in July when the store is practically giving them away because nobody's thinking about winter. Lynch applied that exact logic to cyclical industries, and it worked spectacularly. Sam's mentor explained this to him over lunch one afternoon. Sam had been looking at an airline stock with a PE of 50 and immediately dismissed it. Way too expensive. His mentor pulled out a napkin and drew the cycle. When travel collapses, airline earnings crater and the PE inflates to absurd levels. When travel rebounds, earnings skyrocket, when the PE compresses to single digits. Sam bought at the 50 PE and sold 18 months later at a PE of 12. He'd made more on that single trade than he'd earned in 6 months of managing dinner rushes. Chapter 17 expands this cyclical playbook even further. Lynch gets specific about tactical execution, when to enter, how long to hold, and what signals tell you the cycle has turned. The key indicator? Watch the inventory reports. When warehouses are overflowing with unsold steel, when car lots can't move inventory, when chemical companies are running at 60% capacity. That's the buying zone. Conversely, when backlogs stretch for months and factories can't keep up with demand, the peak is approaching. Lynch compares it to a rubber band. You stretch it one direction, that's the downturn. The further it stretches, the more violent the snapback. Cyclical investors profit from the snapback, but only if they had the courage to buy while the rubber band was still being pulled. And this is the part most people get completely wrong about utilities. Chapter 16 tackles the most boring investment category in existence and makes a compelling case that boring might be beautiful. Utility stocks are regulated monopolies. They can't go out of business. The government requires them to operate. They pay consistent dividends. They're as exciting as watching grass grow. And Lynch argues they often outperform bonds and CDs while providing more upside than either. But here's the really counterintuitive insight. When a utility company cuts its dividend, normally one of the worst signals in all of investing, Lynch sees an opportunity. Why? Because the utility is at its absolute lowest point. Regulations prevent it from shutting down. The infrastructure still exists. The customers still need electricity. A dividend cut in a utility isn't a death sentence. It's a reset button. Sam owned shares in an electric utility that cut its dividend on a Tuesday morning. By Wednesday afternoon, panicked investors had dumped enough shares to push the stock down 22%. Sam's hands shook over his mouse. Every instinct told him to sell before it dropped further. Instead, he remembered Lynch's framework. He held. 18 months later, the company restored the dividend, the stock recovered 35% from its low, and Sam was collecting a higher yield than before the cut happened. The patience nearly broke him, but the math proved Lynch right. Okay, so if that was surprising, wait until you hear how Lynch approached restaurants. Chapter 18 is where Sam's world as a restaurant manager collides directly with Lynch's investing playbook. And it starts with a pattern so predictable that once you see it, you can't unsee it. Lynch identified a growth arc that nearly every successful restaurant chain follows. Phase 1, a single location proves the concept works. Phase 2, the chain expands regionally, 5 to 20 locations. Phase 3, national rollout 200 to 2,000 locations. Phase 4, saturation. The investment sweet spot? Phase 2, the concept is proven, reducing risk. But the growth runway is enormous, maximizing return. You're buying after the restaurant demonstrates it can succeed in multiple locations, but before every highway exit in America has one. Lynch made legendary investments this way. Taco Bell went from a regional Mexican food chain to a national powerhouse. Dunkin' Donuts expanded from the Northeast across the entire country. The thesis was almost childishly simple. The tacos are good, the stores are busy, the company has a plan to open hundreds more locations. Buy the stock. Wait. Had this one hit Sam differently because he lived it every single day. There was a regional coffee chain he loved. 15 locations, always packed, cult-like brand loyalty among customers. He'd recommended it to friends 100 times. He'd watched them open 3 new stores in 6 months. It never once occurred to him that the parent company might be publicly traded. It was. Sam invested $5,000 of his savings. He applied Lynch's checklist one criterion at a time. Earnings growing consistently? He could see it in the sales reports from his own industry knowledge. Low debt? He checked the balance sheet. Insiders buying? The CEO had purchased shares 3 times in the past year. Low institutional ownership? Barely any analysts covered it. Could he explain the business in 30 seconds? He could explain it in 10. Great coffee, loyal customers, expanding fast. 3 years later, the chain had 80 locations. Sam's $5,000 investment had more than doubled. He'd beaten his target date fund by a mile. Using knowledge he already had from working in the restaurant industry every single day. Now, this next idea is the one that ties everything together. Chapter 19 gives you Lynch's complete stock analysis framework, a practical checklist anyone can apply to any company, regardless of industry. The questions are deceptively simple. Can you explain this company in 2 minutes to a friend? Is the balance sheet healthy? Debt to equity below 0.5? Are earnings growing consistently year over year? Are insiders buying their own stock? Is institutional ownership low? And the critical ratio. Is the PE reasonable relative to the growth rate? That last one deserves a closer look. Lynch popularized the PEG ratio, price to earnings divided by growth rate. A PEG below 1 means you're getting growth for a bargain. A PEG above 2 means you're overpaying for growth. It converts stock analysis from an art into a system. Any person with a calculator and a library card can apply this to any publicly traded company. If you only remember one thing from this video, make it this next part. Chapter 20 is where Lynch puts his money where his mouth is. He reveals the 21 stocks he recommended at Barron's Magazine Roundtable, real picks with real names tracked in real time. Some worked brilliantly, some didn't. And Lynch shows exactly why in each case. This chapter is rare in financial literature. Most authors talk theory. Lynch talks accountability. He walks through the winners and admits the losers. He explains what he got right, what he missed, and what he'd do differently. It's a master class in intellectual honesty, and it reinforces every principle from the previous chapters. The gains came from companies that fit his checklist. The losses came from companies where he'd bent his own rules. The lesson couldn't be clearer. The system works when you actually follow it. And finally, the 25 golden rules. These are Lynch's capstone principles, distilled from 25 years of managing the most successful mutual fund in history. Each one is a scar from a lesson he learned the hard way. Let me walk you through the ones that hit hardest. Rule 1. Never invest in any idea you can't illustrate with a crayon. If you need a PhD to understand the business model, you have no business owning the stock. The best investments are simple. People eat hamburgers, they wear shoes, they use electricity, they shop at stores. Sam's friend once pitched him a crypto DeFi AI hybrid investment. Sam couldn't explain what it did in 2 sentences. He pulled out a napkin. He literally keeps one in his pocket now, and tried to draw the business model. He couldn't. He passed on the investment. 3 months later, the project collapsed entirely. Sam thanked that napkin. Rule 2. Know what you own and why you own it. If you can't explain in 60 seconds why you bought a stock, you shouldn't have bought it. Rule 3. Long shots almost never pay off. The lottery ticket mentality destroys more portfolios than any market crash ever has. Here's the crazy part. The most powerful rule in the entire list isn't about picking stocks at all. It's about not picking timing. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Read that again. The fear of a crash is more expensive than the crash. Lynch drives this home with a simple observation. If you spent 13 minutes analyzing economic and market forecasts, you wasted 10 minutes. Nobody can predict interest rates. Nobody can predict the economy. Nobody can predict where the market goes next month. And anyone who tells you they can is selling you something. Lynch also insists, behind every stock is a company. Find out what it's doing. This sounds obvious, but most investors treat stocks as ticker symbols on a screen. They watch the price go up and down without ever understanding what the company actually makes, who buys it, or why it's profitable. Lynch says the moment you forget there's a real business behind that ticker, you've stopped investing and started gambling. And he also warns against hot stocks in hot industries. When everyone at a party is talking about the same sector, tech in the late 90s, crypto in 2021, AI in 2023, that's not a signal to buy. That's a signal that the easy money has already been made. The crowd arrives after the opportunity and leaves holding the bag. And don't ignore this one. If you don't study companies, if research bores you, if you'd rather spend your weekend doing literally anything else, just buy an index fund. Lynch says this without a hint of irony. The greatest stock picker who ever lived genuinely believes that most people are better off not picking stocks. The humility in that statement is staggering. Other golden rules that matter? Owning stocks is like having children. Don't have more than you can handle. If you don't study anything, just index. Spend at least as much time researching a stock purchase as you would choosing a new refrigerator. And maybe the most sobering one of all, a stock doesn't know you own it. It has no loyalty to you. It won't reward your faithfulness. It won't feel guilty about dropping 50% the day after you buy it. Aunt Sam taped that last one to his computer monitor. He'd held a losing stock for 2 years purely because he felt emotionally attached to it. He'd bought it on his birthday. The stock didn't care about his birthday. It dropped another 12% while he waited for it to come back out of loyalty. When he finally sold and reinvested using Lynch's checklist criteria, his portfolio recovered in 4 months, what it had lost in 24. So here are the things you can start doing right now based on what we just covered. First, apply the crayon test to every investment you currently own if you can't draw the business on a napkin and explain it in 30 seconds. That's a red flag. Consider whether you truly understand what you own or if you're hoping for magic. Second, check your cyclical stocks with reversed PE logic. If you own anything in autos, airlines, steel, or chemicals, a high PE might actually be the best time to hold. A low PE might be your signal to take profits. This one move can prevent the most common mistakes cyclical investors make. Third, look at your daily life through Lynch's lens. The restaurants you love, the stores you frequent, the products you can't stop buying, these are investment research goldmines. Find out if the companies behind them are publicly traded. Then apply the checklist. Earnings growing, low debt, insiders buying, low institutional coverage. You might be sitting on the same kind of insight that made Lynch a legend. Fourth, tape this to your wall. Far more money is lost preparing for crashes than in the crashes themselves. The next time a headline screams about an incoming recession and your finger hovers over the sell button, remember that the fear costs more than the event. Fifth, if this feels overwhelming and you don't want to pick individual stocks, Lynch himself said it plainly. If you don't study anything, just index. There is zero shame in that. The greatest stock picker in history gave you permission to take the simple path if the complex one doesn't suit you. That's it for this video. I hope it was useful and gave you something real to think about. Thanks for watching and have a great day.